This isn't an overnight, here's how we do numbers. This has been a 30-year journey. And right now I actually get commissioned by some of our top banks, including BDC, to come in and help business owners that are in the millions, right? We're talking 5 to 20 million, help them with their financial model. It's interesting. Sometimes we think big revenue equals big success and everyone's got their stuff figured out. And the reality couldn't be less true, right? So I'm known as what's called a financial fixer, to be able to come in and go and weed through the numbers to figure out where people are losing money, where businesses are losing money. And then the second piece of this is that I'm known as a money mentalist. So this is 5 years, the last 5 years of my life, immersed into, I guess 6 years now, immersed into the study of neuroeconomics and behavioral finance. Because what we're going to talk about today, the majority, is going to be the mechanics of money, how we manage our money. But I'm going to show you that there's 2 other really important aspects. And this is, why is it that once we know what it is we need to do, we don't do it, right? Or why do we continue to do the things that we know aren't so financially healthy for us? So the intention today, here's what I want you to take away from this slide. It's a couple of things. I want, as I spoke to earlier, my goal in this is to get you comfortable with numbers. And there's only 2 reasons why you are uncomfortable with numbers right now. Typically, the first reason is because of your relationship with money, and we'll speak to that in a little bit. And the other reason, usually fear and anxiety and dread with finances, comes from a place of not understanding what steps to take and how to actually deal with money. So I'm going to give you a very high level perspective today on what the process is to really start making sure that your business has a financially fit and sound and viable model. Because believe it or not, finances are probably the easiest part of the entire business process. And I know everybody, if I did a stop share right now and I saw everybody's face, you'd all be like, no, what are you talking about? With numbers, the brilliance in numbers is that they're black and white. It's a very clean cut process. Unlike things like our personnel department and HR, where we have relationships to deal with and people's emotions to deal with. Unlike marketing, where there's a million different ways we could go, a million different messages we could use, a million different touch points and emotional buttons we could hit. Money is black and white. It's crisp and clear. It's either working or it's not, and it's easy to find out where to fix it. And then start with the end in mind. As you are now looking to either build or reinvent your business through COVID, I want you to understand that the first and most important thing that we need to do is to make sure we build a model that is financially sound for your business. It has to make money. And you're going to see now, I'm not talking about sales. Sales is the easy piece. What we need to do is we need to make sure that there's bottom line profit. And I'm going to come to all of that in today's presentation. But once you figure out with the numbers how to make that financial viability fly, it becomes your tether. It is what pulls you through all of the indecisiveness and all of the decisions that you're going to have to make in your business. It's always like, does this make financial sense based on what my plan is? Yes or no? No, don't do it. Yes, full steam ahead. Right? So it is what guides us through this murky water of, oh, do I do it or don't I do it? What is that going to look like? So here's what I want you to know. Karri already mentioned that I have gone bankrupt. And so bankruptcy is what I call the brick. And many of you, I think this was coined by Oprah, the whispers to the brick. The irony of me being here is that I have always, no, I'm going to change that language. For a good portion of my life, I struggled with money. And so from the time I was 18, I had actually racked up $21,000 of credit card debt. It was a Holt Renfrew credit card because that was my first job. And I felt like I needed to fit in and belong. The other piece is that, you know, for a good chunk of my life, I kept accepting low paying jobs with high responsibility. not believing in myself, but knowing once I got in there, I could prove myself, and then the compensation would follow. And then that even rung true in my business, where I was challenged to charge the right price, second guessing the value. And again, oh, I'll give it to them for this. And then, they will come to me saying, no, it's worth more. It's worth more. So all of that to say, at the foundation of many of my issues, my opportunities for growth with money, was this fundamental belief that I wasn't worthy. I doubted my value, and I kept looking externally for people to validate me. And in the work that I've been doing for the last 5 years, I can tell you that 87% of women entrepreneurs have the same tendency. We don't value ourselves, our time. We think on a peripheral level, absolutely there's value in it. But when it comes down to us actually claiming that value and putting a stake in the ground saying, I'm worth it, this is where we get challenged. So it was the bankruptcy. The bankruptcy was the brick, but it was also my pivot point that got me to invest the next 10 years understanding how to truly manage and master, more specifically, money. And so what we're going to talk about today is primarily in the area of money management, most of it in business, but I want you to know there's 3 realms that need to converge: money management, money mindset, and money motive, for you to actually be able to master money. And so we are hopefully going to touch on that today if time gives us that opportunity. And if not, I don't want you to worry, because I'm going to be putting together, I believe it's today, 2 video segments that I'll send off to Karri and to Brittany, so she can send them to you if you want to learn more about the mindset piece and the more of motive, because we only have an hour and 15 minutes. I want to give you so much here. We only have so much time. So just like my bankruptcy happened in 2009. The economic turmoil of 2008 did not cause the bankruptcy. Just like COVID has not caused the financial disaster that we're seeing in the majority of businesses right now. It simply exposed our fragility. That's it. It had to come out from under the carpet, and now we're seeing everything for what was really there, but we were hiding from it for decades. So before COVID hit, 71% of business failures, closures, were due to poor financial management. And that's a heavy term, because for many of us, we're not even really managing our money properly. But I can tell you it can be from starting off undercapitalized, not charging the right price, not making enough revenue. But at the end of the day, what causes a failure is no net profit. No net profit. That is why businesses fail. And so 89% of the businesses that I have worked with over the past 10 years have actually been generating less than a 3% net profit. And I'm going to come through and I'm going to explain all of this as we go along. But I want you to understand that that 3% net profit that the majority of businesses are so excited about, and they do have a right to be excited because they're not in a deficit position. They're what we call in the black. But for the most part, what do you think the number one expense that we're missing is? Anybody want to weigh in on the chat? What do you think the number one expense most business owners don't have in their monthly expenses would be? I see something here.
Maybe paying themselves.
Paying themselves. That's absolutely it, Allison. Thank you. And Lara, that is exactly it. So once we actually add an owner's salary, our net profit goes down, right? So we get into that deficit position. So here's what I want to share with you, why this is happening. Obviously, we've got a lot of this. It's basically our mindset, right? Is why we're not doing the things that we need to be doing. But quite honestly, we weren't taught about money. We weren't taught about money and finances either in high school, at home, in university. It's all about these big balance sheets. Like there's this disconnection, and there's this stigma around profit. There's this stigma that profit is bad, that it's greedy, that it's dirty, that it's capitalistic, that it's opportunistic. And it couldn't be falser. This is why we saw 2 weeks into COVID, this is why we saw the collapse of businesses, because they weren't profiting. So through all of this, obviously you can see the abdication, right? We give away the power of our numbers to bookkeepers and accountants. We let them tell us what our numbers are saying. We look to them to translate when we're the business owner, and we should be doing that translation. And then obviously we're vulnerable, and quite honestly, we resist actually this whole idea of profit. People actually prefer not to talk about profit, either because they're not making it or because they're afraid that they're going to be perceived in a negative light. And again, kind of opportunistic and greedy and capitalistic, whatever that might look like. So at the end of the day, here's what I want to nail into your brains today. The bottom line is your safety net. You know how in our personal lives, we're supposed to be saving? Well, in business, it's the net profit that is the savings. You're supposed to be taking that net profit and putting it aside as your retained earnings. This is what allows you to weather economic turmoil. In addition to that, now you can pay yourself dividends. You can recruit and train really great people and have them stay. You can acquire assets. So I'm going to tell you, the companies that are going to do really well through COVID are the ones that have been putting the money aside, the profit aside, net profit aside, and now they go and buy up all the struggling businesses. Mark my words, in the next year, we're going to see these big giants go and buy all the smaller ones. This is their strategy. They had a strategy to start with. They weren't just kind of in the fog going, I don't know what the next step is. They knew what the strategy was. And this other piece here, increase the value of your business. Here's what I want you all to do. Actually, I know time is really precious here. I want to stop the share because I want all of you to step away, to push away from your laptop for a moment. Just push away from your laptop. Sit up straight. Take a breath. And here's what I want you to do. I actually want you to start thinking of yourself not as a business owner, but as a CEO, Chief Executive Officer, who is not building a business, but who is building an investment. Your business is an investment, and your net profit is the return on investment that your business is making. For any of you who have money in index funds or stocks, you're probably watching that number. And for many of us, they took a turn, in March and April. They took another dip a while ago, a couple weeks ago. But here's the piece, is that net profit, if you're making 2% on that, and you're making 7 or 8% on an index fund, why are you okay with losing all of that money when the index fund is a 10-minute transaction and here you are putting in 24/7 for 2%, if you're lucky? So as soon as you shift this mindset from I'm a business owner to now I'm a CEO that's increasing the value of this business investment, every time you have a decision to make, I want you to imagine that you're at a boardroom meeting and you're defending your idea to shareholders and to investors, because that will be a huge game changer for you as you move forward now in building your investment. It's no longer a business, it's an investment. Okay, so sorry, there's my little soapbox. I'm gonna come back. Any questions on that? And Karri, maybe if you see questions come in, because I'm not great at multitasking with the questions and everything, but if you see questions come in, just interrupt me. Just say, we have a question, and I'd love to take them in the moment.
Sounds good.
Okay, all right. So I see that we're recording, all that great stuff. Thank you, Brittany, for that. Because yeah, there's a lot of meat to chew on this bone this morning. Your heads are probably already going, what the heck? Okay, so I think at this point, I have probably drilled in the importance of making money and specifically bottom line profit. And hopefully we're all on the same page with that so far. So I promised you that there's a process to this, and there absolutely is. And many of you are trying to figure out, where do I start with all of it? Here's the process. This is it. You follow these 8 steps, and you will know how your business needs to become financially viable. Step 1, we do a personal budget. Right? Most of you are like, what? What are we doing? Why are we doing that? I'm going to explain it. Step 2, we then calculate your indirect expenses, AKA operating expenses, AKA what else? Indirect costs. These are the expenses that your business has to pay, usually every month, regardless of whether or not you sell anything. The third thing we do is we break down revenue streams. So instead of lumping everything into one bucket called sales, we're going to say, what are your top 5, maybe 6 profit centers? How does your business make money? What is it that you sell? Then the fourth piece is we actually look at what should the price of those profit centers be. And again, I'm simplifying this, but we might have profit centers that are, this is an annual membership, right? Or maybe you're selling one specific product, or maybe you're selling that one product but bundled in a box of 4. Whatever those things look like, then for each one of those profit centers, we need to defend a value-based price. And the majority of business owners, this is where they hemorrhage money. Between number 4 and number 5, they start off by picking a price based on what their competitors are doing. That's usually what everyone does. So-and-so is paying this or charging this, so I'm going to be in that ballpark. I need to be in that ballpark. And most of us go, well, I'm going to come in at the lower end of it because I'm just getting started. And right, we do all of that stuff. Okay, number 5, direct expenses, otherwise known as cost of goods sold, right? These are the costs that are directly attributed to selling that product or service. We are out of pocket for that product or service to go out the door. So that's the difference between indirect and direct. And again, where most companies, again, when I'm working with those $1 million businesses, where companies are usually hemorrhaging their money is in not doing step number 4 properly or step number 5 properly. Then we plan for profit. This is fast. Really, this takes 5 minutes. I'm going to show you how. And then we do what's called a marketing map. Because once we plan for profit, now from the bottom up, we actually are able to see how much our business needs to generate from a revenue perspective. That's what defines our sales goals, not 2% of market. That is just BS. When we do that anytime, when I'm listening to an investor pitch and someone's, oh, we're going to get 4% of our market share, and show me how, and show me why that's important to you and how that defends your net profit. So the marketing map is really about defending, breaking down, and being able to defend the sales goals or the sales assumptions that you've made in your plan. And then number 8 is milestones and measurement. And what's really important about this is that when we plan for profit, we're actually planning with the end in mind. Remember I said start with the end in mind. I want you to build a financial model that's viable. And then once we understand what that's going to look like, we're going to break it down into incremental goals and milestones so we can achieve it. What most of you, I suspect, are doing is that you're coming from the place of where am I right now? What can I afford? What can I not afford? And then this is what keeps us stuck. So this is where we start with the end in mind, and this is the process. And very quickly, what I want to share with you here, because I know when I was first figuring out my numbers 20 years ago, this was all very gray to me, but I want to show you that financial statements, when people are talking about financial statements, 3 different documents go into financial statements. We have the balance sheet, and at home we call this our net worth statement. It's the exact same thing. It's a list of all of our assets and all of our liabilities. That's what's on the balance sheet. The income statement, quite honestly, also known at home as a T4 statement, it's a high-level summary of all of our income / revenue minus our direct expenses or cost of goods, which is going to leave us with a gross profit. And next time, listen to people's financial conversations, because most people will talk about gross profit. It's a safe number. It's a safe place to land. It doesn't look terrible. It's usually pretty good. And then from gross profit, we subtract indirect expenses, which then leaves us with our net profit. So this is usually a high level summary, and it's usually a comparative over 2 periods, like period 1 to period 2. Might be quarter 1 to quarter 2, it might be year 1 to year 2, whatever that looks like, might be several years, but it's a high level summary of this little baby called the cash flow. And this is, sorry, I'm just gonna move my gallery view here. This is where we spend our time doing planning for profit. It is in the cash flow. It's the ups and the downs. And so the cash flow is basically a detailed version of your income statement where it lists all the different income streams, right? Our profit centers, all of our direct expenses, AKA cost of goods for each profit center, ideally, and then all of our indirect expenses, and it shows up how we end up with a net profit. Knowing that some of these months you might not be in a positive, right? This is why Black Friday is Black Friday. It's because it's the first time for retailers, maybe not through COVID now, but it's the first time for retailers that their profit actually turns to black, right? They actually start making money because for 10 months out of the year, they're operating at a deficit position. So this is also known in our personal world as the household budget. So I bring this up because this is where we're going to spend the majority of our time. Now, quickly, I want to explain the personal budget to you, and that is because why businesses fail is because of net profit, but it's also because our business finances are mirroring our personal finances. It is our personal relationship with money that gets brought into the business, and which is why the business doesn't make it. So the first thing I need you to do is I need you to do a personal budget. I need you to figure out how much money every month do you need to be putting into savings, spending, and spending, just so you know. So savings is short-term security. It's your emergency fund, and you might need to be topping that up as a result of COVID. Spending is spending on needs, your wants, your splurge account. So this is your allowance that you get every month. Every member of the family gets an allowance, and you use it in cash, not your debit card. And then it's about getting out of debt in 36 months. So how much would you need to be able to, how much do you need in your spend category to make sure that those areas are covered? Investing is long-term security. And this is your retirement fund. Everybody gets kind of caught up in this, especially now, and oh, I need to get my money making money. The reason why you're getting money making money is so that the time where you can no longer make money, you've got enough money set aside to actually make sure that you can take care of yourself financially. And just as a side note, for any of you that have kids, with investing, this is where compounded interest comes in. And this is so amazing. If you were to put $20 aside every week from the day that your child was born, and you put that aside, $20 a week, by the time they were 60, you put it into an index fund that was making 8% annually, you would have 1.5 million by the time they were 60. If you were to put away $25 every week for your child, you'd have $1.9 million for your child. So there's power in compounded interest, but the sooner you start, the sooner your money gets making money. Then we have share, which in my world is taxes to start with. And most business owners are not putting money aside for their personal taxes, which gets them into a heap of trouble at the end of the year. And it's also about our philanthropic give back, our social impact. Where do we want to make impact there? In our community, in our environment, in our economy. And then here's the big issue. You can see here that I've put here a number of the big areas that I see entrepreneurs struggle with when it comes to these personal areas. But the biggest one of all, and this is why I want you to do the math, is that most of you are doing what you can with what you make. You're going, okay, well, we make this and we'll try to put this over there and we'll try to do this over here. And then most of you are feeling like there's just not enough money at the end of the month, which is why Canadians are the worst country in the world for our consumer debt. We're number one. We've surpassed Greece. We spend $1.74 now for every dollar that we earn, and it's all going on credit cards. So especially for women entrepreneurs, what you're doing is you're saying that, you know what, if the business can just pay me $3,000 this month, that's okay. I'll just take it. and I'll take it at the very end of the month, or I'll take it next month if I need to take it. I'll put myself last. I'll be the money martyr, and I'll just take what the business can give me. No, 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 no. You have to put yourself first. If you're not taken care of, the business is doomed to fail. So you need to figure out what your budget needs to be, because this, lovely ladies, becomes what I call the magic number. This is the number that your business needs to pay you on a monthly business, so that you have an emergency fund, you have a nest egg, you've mitigated the risk in your business, you're able to pay down your debt, you experience life, right, through all the things that enrich you. You take pride of your philanthropic impact, you pay your taxes, you earn what you're worth, and not most importantly, just as importantly, for those of you who have kids, your kids are watching you. They're watching every single move that you make, every word that you say. They're watching you not pay themselves. And so when you start to do this, and when you show up powerfully for yourself and your family, they observe that, and that redefines their financial trajectory. If you can't do it for you, do it for them. And that is what motivated me in 2014, because I realized that my daughter was taking on my habits when it came to the martyrdom piece. So step 2 in all of this is now indirect costs. And so I'm going to show you high level. I just want to show you a couple of big pieces here, again, because I just want to draw your attention to where a lot of mistakes are made. One of the very first things that I want you to do when we get off this call is to go to payscale.ca. I want you to type in general manager of your business, right? So your industry, the city. It's going to ask you, what city do you live in and what are your areas of expertise? And I want you to type in the title general manager. And it's going to give you a range for what a fair market salary is for your role. And I suspect the vast majority of you are not earning that. That is the first thing that you should be accounting for in your expenses. And again, I want you to think high level. This is your wish list. This is for you to build this into an investment that's solid, that anyone would come into and say, you've got everything covered, you're doing really well, this is what I want you to put on the list. So owner salary, you're going to do that. Source deductions, as you start to build a team, just remember that if you've negotiated $100,000 salary, you're actually out of pocket about 116 because of source deductions. You have to add that above and beyond. Right? And if CRA comes in and does an audit and they go, oh, this person is actually an employee and not a contractor, like many of us do in the beginning, those source deductions will be retroactive from the time in which they felt that person was an employee and not a contractor. So let's just budget for it here. The other piece I want you to budget for, I'm going to jump around here a little bit, is the marketing mix. Whoops, not jump around in slides, but the marketing mix. So what I want you to do when you're budgeting for all of these basic materials and website and meals and entertainment, these are all things that you're going to have regardless of you selling anything or not. But I get business owners to budget just a threshold for our step number 7. And so I'd like you to budget for maybe 5%, 3 to 5% of what your current revenues are. And I want you to set it aside. So it could be $500 a month. It could be $1,000 a month. I usually like to aim high because it's easier to subtract than add. So even if you're feeling really courageous, I would budget for $2,000 a month. And I'm going to show you how we come back and edit that and defend that later on. Now, the other piece, I put this here because I didn't want to forget to explain why I break this down into 4 categories. Most people just have a list of, here's all of my expenses, right? It's a big bucket list and it's like, it's A to Z. Quite literally, your accountant has probably organized it A to Z. Why I break it out into 4 is because I want to be able to measure the return on investment each one of these categories is making me. So my team and personnel, if I put all of my people in that one bucket, I can take that expense, divide it by revenue, and it'll show me how productive they are. And there are benchmarking standards that we can use that will say, on average, a business your size, the productivity of your team should be X. But most people aren't even doing that math because it's all over the place, right? We don't know what all of those costs are. The other really cool thing is that, and this is why I've highlighted marketing support and consultants, because let's say in sales and marketing, you decide to outsource your social media. That would be a marketing effort that most people are like, well, marketing, you can never measure the return on marketing. Like, it's just this big gray area. It's the ethereal kind of, you know, how are you ever supposed to do it? This is how you do it. So if you know, if in your costs, if let's say your sales and marketing, including your consultant, comes out to $10,000 and 10,000, let's just say hypothetically, it's 3% of your revenue that's coming in. The next, whatever period you want to use, whether if they've said, oh, no, you're going to get results next quarter, or, oh, this is going to take a year for these results to come in. When you know that you've spent 3%, guess what? The next year then, you don't just want to see a 3% increase in revenue. You ideally would like to see it double, if not greater, right? Because if you've made 3% increase, you've broken even with your efforts. I don't want you to break even. I want you to have a lift. It's that simple. Again, numbers don't lie. It's brilliant. It's beautiful. So here's the last piece I want to show you is the owner's dividend. So when I did this work, I won't get into the big backstory on this, but my husband decided to leave. Our relationship ended up in the rocks 2017. I felt I was a really strong money manager, and this is what prompted me to understand the salary piece. Because when I went and did this math now to go, how do I support my child and myself on my own? I had to go from 4,000. I was earning 4,000. I thought, oh, 4,000 is okay. Hence that whole experience of me sharing, we do what we can with what we make. I was putting in 4,000 a month. I thought I was contributing my share. But when I actually did the math, I actually had to earn $35,000 a month. $35,000. And most people don't want to do that magic number work because they're terrified of what that number is actually going to look like. And that's a mindset piece. I'm going to speak to why you're not making your magic number. So first, we actually really have to understand and grab it by the horns how much we need to be bringing home. And so if then I say, okay, well, my owner salary, you know, $350,000 a year is not going to fly with investors and shareholders. They're going to go, that's a little exorbitant. Where you would make the difference, you put in under team and personnel, you put your fair market salary, and then the difference I want you to show under others, under owner's dividend. And this can be paid out quarterly. It can be paid out however your business can afford you to pay it out. Ideally, it's monthly, right? But this is how we break the two apart. I'm going to take a quick little break here and see if there's any questions on that, because I've given you a whole whack of information there. But again, I want you to know that there's a process to this, and I have all the tools and templates for you. You're going to find those tools and templates at nailthenumbers.com. When you go to the home page, if you scroll to the very bottom, you're going to see a section that says Crush It, Founders Toolkit. You just have to click on that, enter in your email, and it's going to give you access probably to about 60 different playbooks, tools, calculators. It's all there for you. I want you to know that I am with you for the long haul. It's not just this 1 hour presentation. Whatever you need to wrap your head around these numbers, I've got your back. Women Entrepreneurs has your back. We're here with you. I just want to show you there's a process to this, and every single business does the exact same process, and they win every single time. So, sorry, I said I was going to break for questions. Karri, are there any questions?
Nothing on chat, but if anyone wants to unmute and ask a question, go ahead.
Okay. You know what? Either way, again, I'm here for you. We can take questions at the end. There's a lot of information to digest. I get it. And we're kind of I'm feeling like we're on a train, but that's where I'm like, oh, I get so passionate about this darn stuff. Okay. So this is a simple step. Step 3 is so simple. It's break out your revenue streams. So instead of, what happens is that when we lump everything into sales, and I know accountants do that. When we look at our notice to reader, we just see, oh, here's all of our sales. But when everything is lumped into one bucket called sales, we cannot then articulate what product or service is most applicable to our market? What is selling the most? What are our customers most excited about? Because inevitably, I always see customers, especially when, my clients that are 4, 5 million, 20 million, there's an appetite. They're selling something that people want. But when it's all under sales, we don't know where the volume is. We don't know what people are super excited about. So I want you to just break that down. And just a small little detour, when we lump all of our cost of goods, and I was so excited, someone from one of your other groups actually sent me their numbers, and they showed me that they had their cost of goods separated for each revenue stream. I was like, oh, the little number fairies came out, the little angels, they were singing, they were like, it makes so much sense. Because when we lump all of our cost of goods or direct costs into one bucket, that's just cost of goods, we can then not articulate what product or service is most profitable. What brings you the most amount of bottom line money, right? So this is why we need to separate the two. Now, I do want to spend time on this because this is very important, and this is probably one of our weakest areas as women entrepreneurs, is our pricing strategy. So I want you to know, again, actually it's not in there now, I'm going to put it in today. It is called the weighted pricing model. It's a worksheet that you can download from nailthenumbers.com. You're going to have to do this exercise for each product and service that you have. Step number 1 is you select that product or service. Step number 2 is you research your competitors' offering and what their price is. And I know I said don't base your price on competitors, but here's where you do your homework. So what are they offering and what is the price attached to it? Then you have to determine your consumers or your clients, I prefer the word client, your client's top decision-making criteria. So in their head, what is the process? What are the questions that they are asking themselves as to whether or not they're going to do business with you? And I've given some examples here, but I have to tell you, in every single experience, every single client usually has different criteria. So the examples I've used here are soft skills, which are like your people skills, hard skills, which are your technical skills and areas of expertise and education, industry experience, the brand promise, which means are you a high-level brand or a low-level brand? And there's no rights or wrongs here. You've got dollar store compared to Holt Renfrew. So are you at the best at what you do, which most businesses, I think on autopilot, we usually say top service, top quality, top, right? Like best. Or are you sitting in a space where no, you're a dollar store, it's mass volume, mass produced, but again, there's an opportunity and a market for that. The unique offering, which really means how competitive are you? Is there a lot of people in this space, right? With online courses right now, there's a lot of people in that space, right? Or is this something really, really unique, right? That people really aren't talking about right now and there's not a lot of noise for it. And then the pain point, which means, are you putting a Band-Aid on something? Is it a minor scratch or just a surface lesion that you're solving? Minor problem, or is this life-saving, right? So that is the pain point. So the next piece, so you're gonna come up with your own criteria. You can use this if any of this resonates with you. The next thing you do is you score your product. You take a very objective look and you step back and you're the CEO and you're the investor now. And you're saying, okay, on a score of 1 to 5, that's important, 1 to 5, how does this product rate in soft skills? The people around this product, right? So in this case, this example, it's a 3. Technical skills, hard skills, a 4. Industry experience, a 4. Brand promise, a 5. So obviously they're saying they're the best at what they do. Unique offering, there's relatively a lot of noise. It's not saturated yet, but a lot of noise. And pain point, kind of in between the life-saving versus the Band-Aid. So what you do next is you add up this score, and you can see over here, if we add up all of those numbers, we're going to get 23. You divide it by how many pieces of criteria you used. In this case, it was 6, which gives us a 4. So now here's what you do. You've got a scale here, 1 to 5. And on the low end, your lowest competitor was charging 25 and your highest charging competitor was charging 125. So if you're a 4, you are going to sit in around this $100 mark with respect to your price. Sorry, I was looking for my mouse. Can you see that? So if now you can go, okay, well, if I'm a 4, I'm $100. I'm going to tell you the majority of women entrepreneurs I work with would probably be pricing themselves here at 50 to 75 and feeling so uncomfortable about going to 75. But here's what I love about this exercise. There's a couple of things that this does. One, you actually objectively now see your value of the product and service. This isn't you coming from a place of, oh, this is me. This is an extension of me. This is my, this is my baby. This is about how consumers will perceive your product or service. So you see the value. The other thing in here is that it actually informs, when you start going through where you're coming up with this score, 3, 4, 5, it actually informs your key messages for marketing. Right? Because if you know what your customer's basing their decision on, and you can say your soft skills are a 3 because of A, B, and C, now you've got marketing messages, right? So that can defend the product and can defend the price. And here's the third thing, is that when we do all of the math, if we do the math and we need to create a financially viable model and the $100 price point isn't cutting it, and we need to jump up to 110 or 125, guess what? We know what we need to work on. We need to work on soft skills. Maybe we bring a consultant in that has X number of years of experience in project management, right? Maybe we need to figure out our language to figure out the pain point. So wherever these scores are weaker, we know that if we can adjust these scores and increase them, that will allow us to increase our price. Done, bam. Now we have a price. Now, most people are uncomfortable with charging this price, but again, I want you to know that what we're doing is we're creating the financially viable model, and then we can work backwards to be able to achieve it instead of trying the other way. Now, the other piece I want you to know on pricing, right off the top, I have to tell you, you should all be increasing your price by 2 to 3% every single year. Why? Because of inflation, right? All of our expenses are being increased ever so subtly by 2 to 3%. So if we're not adjusting our price by 2 to 3%, it's coming right off the net profit. 2 to 3%, there's your 2 to 3% right there, boom, done, right? So step 5, this is the other important step. That's why I want to spend time on this one as well, is our cost of goods. So I want you to spend time on your pricing, and I want you to spend time on your cost of goods. And before I forget, because I don't want to forget this piece, it is so important when we look at this process. And again, there's the 8 steps. There's the personal budget, the indirect, the revenue, right? When we look at the 8 steps, I want you to think of each one of these steps, and they need to be done in that order, as just a little mini project. I don't want you to be thinking, oh my God, this whole profit hourly process, like it's going to overwhelm you. So just break it down into small little baby steps. So our cost of goods, this is every single time, this is where we find money. You've got a treasure chest sitting in your cost of goods. So the first thing you need to do is you need to figure out all of your material expenses. And I'm going to tell you that most of you have already done this. This is the easy work. Most of you already know what your material costs are for your cost of goods. It's just, I've got this and this and this. I'm selling a glass of lemonade. There's the lemonade. There's the not that you would pay for ice cubes, but maybe you would. I don't know. Maybe they're infused. There's the glass. There's the napkin. You've got that. I don't need to belabor that. Second piece is inputs. We oftentimes miss little things. You can see I have circled merchant fees, because merchant fees are typically 2 to 3% of the transaction value. And every single business I work with puts merchant fees, because this is the way the merchant gives you your bill. We have them as operating expenses. But 2 to 3% of 25,000 is one number, and 2 to 3% of 100,000 is a completely different number. And if we don't budget for it in cost of goods and we put it in operating expense, we lose that 2 to 3% off of our net profit. Done. So now you're at 6%. We've just made you an extra 6% in net profit by doing those two little things. The other thing in inputs are shipping, duties, exchange. So exchange rate, you have to go high on this one, right? Because, I mean, we saw what happened with our US dollar, and who knows what we're in store for going forward. If you can change your suppliers to Canadian suppliers, definitely do it. I know there's also brokerages that will hedge the exchange. We can talk about that another time, but definitely we've got to factor that in there. If you have contractors, subcontractors that are working for you, this is where you input their rate, and make sure it's not just their rate, but any per diems that they're charging, travel that they're charging, any miscellaneous expenses that they're charging, and also make sure you get a contract with them that says, these are the terms of this agreement. This price is in effect for the next X period, because otherwise you could lose a lot of money on that. So get that in place. If you have commissions, this is where commissions are shown, is in your cost of goods. And then equipment. And I just want to speak to this. I usually see this more in mail-based businesses where they're either leasing out equipment, or they're using like $750,000 pieces of equipment to get a job done. We've got a template, believe it or not, that will show you the equipment cost per day and per hour. So if you're budgeting, if you're putting together a plan to sell a specific service, or maybe it's a proposal and equipment is a big piece, I want you to understand what you're out of pocket to have that equipment dedicated to a specific service. So now this is going to end up bringing you at a specific total. As you can see here, obviously hypothetical, $25. So what you do here is you just take 25 plus 25 equals $50 for cost of goods. You divide it by your selling price of that product or service. Again, remember, this exercise is done for each product and service. And now we end up with 50% cost of goods. That's how we end up with what your cost of goods number is. That's what bookkeepers and accountants will be very familiar with. They'll be like, okay, good. Now I want you to go one step further. And I actually want you to understand labor costs, not for the cash flow template, but to make sure that this is viable. So I want you, for selling that, now this is probably going to relate to more service-based businesses, but I want you to break down the labor that is associated with selling that product or service. What is the task and how much time needs to get devoted to that task? And you multiply it by the rate that you would be charging, or not charging, paying for that person to do the work. Even if it's yourself, right? Fair market salary, take that down, divide it by your hours so you can see what the hourly rate is. I want you to understand the costs of the labor involved. Because in this case, we've got an example of $25 to sell that product or service. When we add that 25 to the 50, we end up with $75, which actually puts us at a 75% cost of goods. I can tell you, for most solo entrepreneurs, when you do this work, when you calculate your labor in here, most business owners I work with end up at an 85 to a 95% cost of goods. That right away shows us that this model cannot be turned into an investment or a business. It would stay at a job level because you can't scale. There's no way for you to scale based on that. So then we need to look for ways to scale, right? We need to either find a way to adjust the price, adjust the expenses, or find a way to leverage your time and to get other people in to show us how to turn this into an investment, not a job. Does that make sense for everybody? Just give me a thumbs up. Let me know you're all on the same page. Awesome.
Tanya,
Karri, was that a thumbs up or a question? I think that was a question.
There's a question. Yeah, so Brandy has a question.
Okay.
She writes, I have a contractor who does both my internal work and helps with client work. So should I be splitting her costs between operating expenses and direct expenses?
Yep, absolutely. Yep, good question. That's exactly how you would do that for sure. Okay, so there's a lot of meat on that bone. It's going to take a while to digest it. There is a recording of this. The playbook is yours as well. Again, I just want you to know that there's a black and white process to just seeing how all the numbers come together, and then we can fix it, right? But most people don't do this work until they're drowning, and then they're trying to fix it. So let's do it now. Okay, this one I lose people on all the time. So I'm just going to tell you right now, you're going to get lost in what I'm about to share with you. I just want you to show you step by step, and I've written it over here. This is exactly how we do it. When I'm doing a boot camp, this is supposed to be like a 5-minute slide, and sometimes it takes me 45 minutes so that everybody gets it. So again, I just want to show you this is how we do it. This is the magic. So the first thing we do is we total all of your indirect costs. This was step 2, right? What are all of your indirect costs? What is the total? $100,000. Step 2 is we take our direct costs now. We add them for each product and service, and we get our average. And in this case, we said 50%. So we know that the percentage value of our direct costs is 50%. We know that. It's done. That's a given. Our third step is that we actually plan for profit. And in this case, this can be a stretch, I know, for a lot of business owners, but it goes back again to if you could put your money in an index fund, and I know that 8% would be generous right now, but even 5%, for the love of Pete, for 10 minutes worth of work, you could be making 5% on your money. I want you to at least build an investment that let's just aim for 10. Let's do a 10% rate of return. Because the other piece, just so you know, that if you ever go to sell your business, and hopefully you're planning with the end in mind, and you've got this horizon of, okay, in 5 years, I'd like to be able to potentially sell my business down the road. Oftentimes your valuation, and there's many different models, including your assets and including future earnings of your sales, AKA sales. But one of the go-tos is a multiple of what your net profit is. So if your net profit is 25,000, in some industries, it might be you multiply that by 3. In others, it might be you multiply it by 5. But if your net profit is only $1,000, you're going to multiply that by 3. And you're going to get $3,000 for your business, right? In this case, we've got 75,000. Not the greatest example, because hopefully it's more. So here, step number 3 is your net profit. You decide what that's going to be. So step number 4, this is usually where I lose people here. Actually, no, it's step number 5. So number 4, if we take 50% of your direct costs, so we know direct costs are 50%. If we take 50% of your direct costs and we add 10% net profit, that gives us 60%, right? 50 plus 10 is 60. We subtract that from 100% of your sales. So 60 minus 100% equals 40. That is how you come up with the percentage value for your indirect costs. Your direct costs plus your net profit equals 60. You subtract it by your total sales. Don't worry, your total sales are always going to be 100. You're left with 40%. Here's where I lose people. Now, for us to determine sales, we simply take $100,000. We take our indirect costs. We divide it by our percentage value of 40% here, and we end up with our sales need to be 250,000. That's how you do it. That is exactly how you plan for profit. So at that point, I'm actually just going to come over here for a second. When we know then we have to generate $250,000, we can then start to separate our revenue streams. Okay, so how do we want to do that? In this case, let's just say we had one revenue stream and we had to sell just widgets. We know that we're charging $100 for each widget. We already went through that exercise. So that means 25,000 divided by 100 means that we need to sell 2,500 widgets. This is step 7. This is the marketing math. So there's a process for this too. And I call it the rule of 10 unless we can defend otherwise. So our process means that we don't just pick up the phone or do a social media post and we expect the sale. We expect that we create awareness with social media. That then leads to interested people that want to get to know us and our product a little bit more. They usually land on our website. Then we might have a discovery interview or free test or whatever that looks like, which then leads them to engaged. Now we start talking price, right? Now we start talking value, and then they end up in sold. So if we apply the rule of 10, for us to sell 2,500 means that we have to have 25,000 consumers engaged with us, enough to actually want to buy. To have 25,000 engaged, we need 250,000 interested. To have 250,000 interested, we need 2,500,000 million people aware. Now, those sound like very high numbers. I know in most of your models, these numbers, these targets don't need to be reached because most of you can defend a rule other than the rule of 10. You might get 3 out of 10 people moving into your website after a social media post. You might get 50% of those people, right, moving into engage. So if you can defend a different rule here, you can use this, but it shows you exactly how many people you need to create awareness with. And now in each one of these pipelines, so I guess if this is an overall pipeline, in each one of these steps, verticals, there is a different tool that's used, a different message. And once you understand what the tools are and what needs to be created and what needs to be implemented, this now informs our marketing budget and when those things need to be paid for, the time period, right? Because in real estate, usually houses sell in spring. Maybe you need to get in front of people in January or February, which means you have to have all your tools done in January. So if there's one piece of this process that you'll notice is consistent, it's about reverse engineering. Start with the end in mind, know what your goal is, and start to work backwards from that. So when we understand that sales goal, this is what we call the magic number in business. And again, it is about ensuring financial security. So what ensures the security is not the top line, it's the bottom line. And that's what I really want to drill in. And once you get that bottom line profit, you're protecting yourself, your employees, your clients, your investors, right? You're getting paid fairly in this process. You're growing an investment. We talked about that. You're an investor now, right? You're the CEO. You're going to be able to ride out economic downturns. So if we, Lord forbid, we get another pandemic, you know, when I was doing this work before COVID hit, the biggest natural disaster that I would always share with people was our Diefenbaker Dam. If that were to break in 4 hours, Saskatoon would be under, half of Saskatoon would be underwater with no backup generators, right? And so not being able to access money. And I never planned for a global pandemic in all of my financial boot camps. But I hope that I've really gotten through here, that it really is about net profit at the end of the day. And so what I want to share here is that the vast majority of us are looking at this is an income statement. I want to impress upon you that our financial pillars of earning, spending, sharing, investing, saving are all the same in business as they are in our household budget. It's the same categories. And what most of us do here is we take this notice to reader and we look at this 4 months after year end. And then we're like, oh, we get the surprise of a lifetime. And usually it's that our net profits aren't where they were supposed to be, that we lost money, that we didn't do as well as we thought we were going to do. So I want you to know that one thing I love to do is I love to look at numbers in terms of a percentage point, in terms of percentages and not necessarily numbers, because when we look at this, it's hard to really understand what's going on. Sure, we can see at the bottom of the day, at the end of the day, we've lost money, right? We went from a $121,000 profit into $151,000 loss, but we wouldn't even know where to start. I've shown you the process. And what I want to show you here, what is fascinating to me, is that if we look at, so these are the exact same, it's the exact same data, it's just converted into percentages. So if we look at their total sales, 4.1 million, they didn't have a breakdown of where they were getting their money, right? We didn't know what the revenues were for each one of these categories. The direct costs, we didn't know what the direct costs were for each one of these categories. We just knew they were 110%. Right off the top, we know we can't survive in business with 110% cost of goods. And then in our, when we looked at our indirect costs, we started to break this down. We started to break it apart. And I could see that, you know, team and personnel, really you can't survive in business at 1.79, right? It means no salary there for the owner, which I said is pretty consistent across the board. So at the end of the day, they were spending 3.79 on indirect costs as a percentage, and their net profit was negative 14.9%. This is usually when I get the call for help. They're usually at this stage and they're going, what's wrong? I'm making money, but there's no net profit. If you do this process now in your business, you will never run into this problem. Because first of all, you're going to be measuring your numbers every week to get the hang of it. So if there is a problem, you start to fix it. But I want to show you what we did. The first thing we did is we came here to our indirect costs and we broke them all down. We gave them a salary. We actually increased space and operating, sales and marketing. And from every single business owner I've worked with so far, we do increase indirect expenses because most of you are bootstrapping and coming from a place of scarcity. So we increased the indirect costs. We separated out the revenue streams. We assigned for each revenue stream, we did the math and assigned a cost of goods attached to each one of these buckets. We actually planned for 9.3% net profit, which meant that their sales actually had to come in at 3.8 million. They were a business that was operating at 4.1. We just did this math. Their sales, the plan was for the sales to decline, for them to pay themselves, but because we did all of this uncomfortable work, we ended up with a net profit of $353,000 or 9.3. That was the plan. And now the irony in this work is that it never goes according to plan. It usually always gets better. So in this case, within 13 months, they actually ended up posting a profit of over $700,000. Over 700. It's when you can see how something is going to be achieved that you actually start to believe that you can do it. And that is the brilliance in this planning for profit model. So step 1, personal budget. Step 2, indirect costs. Step 3, revenue stream. Step 4, price for profit. Step 5, direct costs. 6, plan for profit. Do your marketing map. And then measure, measure, measure. And you always get there. Always get there. And again, as I mentioned, I'm going to do a video for you on mindset and motive. But what I do want to impress upon you is that this is the easy work. What is stopping you right now from actually achieving this is your mindset. 95% of the decisions that you are making every single frigging day are coming from your subconscious, and you are doing it unconsciously. You are on autopilot, and your subconscious is motivated to keep you in a place of comfort, of familiarity. Actually, I want to use that word instead, because a lot of you are like, doesn't feel so financially comfortable right now, but it does feel financially familiar to your brain. And so the work that you need to do, I especially want to impress this upon women entrepreneurs, because we have a tendency to think that we have so much hard work to do. And we work 24/7 and we slave and we're like, oh, I'm doing more and more and more at home and in business. The real work that you need to do is the uncomfortable work. If you were to spend just 15 minutes a day doing things that make you uncomfortable, your life and your business would transform overnight. Instead, we're choosing to do things to keep us busy, which keeps our prefrontal cortex thinking that we're doing all the right stuff. And that is really my mission, is to help women see and believe and live their magnificence, because you all have it. You all have it. This is the thing. We think that we're broken and that we need to be fixed and that we need more education, and we don't. We actually just need to be vulnerable enough to let our real selves shine through. And that is my mission in life, is to help you see your magnificence. And I love to do it through the power of money and numbers, because this is so uncomfortable for so many people. And so again, I just wanted the money management piece. This is where we've spent our time today. But please know that, you know, I'm going to give you tools and templates out the wazoo. Out the wazoo, you're going to have everything you need. And then you'll be like, oh, but it feels so uncomfortable to charge this price, or it feels so uncomfortable to make the sales call, or it feels so uncomfortable to pay the taxes. That's the work that we need to do. Hence the motive piece, which I will get into in the video for you. So, you know, to close this off, obviously, again, thank you for being here. Thank you for having the courage to take this mission on, especially through COVID. And thank you to women entrepreneurs for being there for everyone. Again, I do have all the tools and templates for you, and they are there for you. I'm also there for you if you need 15 minutes, a half an hour of my time every now and again to say, what am I doing? All of that's for you. And if you would like to go through this process kind of step by step and take this on and wrap your head around it, because of the generosity of women entrepreneurs, you can take it for 50% off. And it starts October 5th, and it's a mastermind group. So it's limited to 10 people. So it's not this online course that you do on your own. We take you step by step through each one of these, and we go through it together. And it starts on the 5th. So please don't hesitate to reach out. My email's here, my phone number's here. You can send a text. My personal website here at epiphany.ca. But again, where is it? nailthenumbers.com, right here in this corner. This is where you can get all the tools and templates, all there for you under the Founders Toolkit. All right, Karri, do we have any questions?
We do. First, before we get into the questions, I just want to say a huge thank you to Tanya for that outstanding presentation. That is a lot of information in a very short period of time. So I'm very, very grateful for your knowledge and for getting our appetites whetted. It's been really great. So thank you. So the question that we have comes from Joanne, and she was asking a question a couple of minutes ago. Her question was related to the example that you shared and asks, what change did the business owner make to achieve that profit in the end?
Sorry, so we're talking about the example. So yeah, it's, you know, it was interesting because it's really, again, like all of you, you have all the tools that you need. You just have to understand what you need to implement and when you need to implement it, right? Like what levers to turn on and off and when. So this company that I was working with, they just got really specific about their numbers. They knew, because where they were losing their money was in their cost of goods. So every week they would sit down and per project, they would go, our budgeted cost of goods is 75% as an example. And in that week, if they saw that they were going up to 76, they knew the next week they would have to find a way to bring it down. Send someone home off the project, negotiate with the supplier a 1% discount, right? They were fixing it in the moment, which is where they found some powerful results. But I have to tell you again too, that marketing mix, when we understood, and I forget the exact number, but I think we had to get 35 projects on the books. And when we did, and you saw on that slide, you know, Marketing 101, and I know you're going to have these courses coming up, but know your audience, know their pain points, know what problem you're solving for them, especially through COVID, right? Noise is not tolerated now. Like you have to get very, very focused on what problem are you solving for your customer, because they're getting really smart with their numbers and money. So they knew that, you know, we did some really fun math where we understood that, and some insight, knowing that their market base was going to be in Saskatoon, in some of these residential inner city neighborhoods like Spadina Crescent and Varsity Heights and Natana. And we actually had a strategy that for each construction project that was happening, we went to 10 houses around that construction project, and we had these beautifully packaged earbuds, because their message was their cleverness. These were two guys from Ireland, and so there's a whole marketing strategy around that, but they delivered earbuds, and they said, you know what, we know your neighbors are in the middle of construction. We know this is a really frustrating time for you. If you want to take on a project of your own, kind of to, you know, one up your neighbors, feel free to give us a call. our budget, we had whatever it was set aside, $7,000 a month. We did this one little box that cost about $600. We had a 1 in 10, the rule of 10, 1 in 10. We had budgeted 1 in 10. Out of every box that they sent out, they had 7 responses. That's as far as we could take it with the marketing plan because they had already exceeded what their projections were going to be. So you just get really specific. You just get really specific and smart with what you need to do, and then you just have to go out and do it. So sorry, that was a long-winded answer, but I thought it was really fun to show you the social media piece. Oftentimes for women, we hide from our brilliance, and social media allows us to do that, right? Because we don't have to go out and shake hands and tell people why we're great at what we do. So this is what those guys did brilliantly, is they just went out there and did it.
Great, thank you. A question from Laura. Just curious, in that example where you crunched all the numbers for that home builder, which revenue stream was most worthwhile from a profit cost perspective?
Yeah, so great point. So when we go back to crunching those numbers, what they didn't realize is that for each new home build they were doing, they were losing $10,000, right? They didn't see that. And it's interesting when you look at the numbers, that's what they started to focus on, which is why they started to lose their numbers. So when we started to crunch all the numbers, it was the medium and large size renovation projects that really accounted for their profitability. So we knew they could only take on 3 home projects a year, otherwise it would affect their net profit, that they went after the renovation business in their model.
Great, thank you. Any more questions from our participants?
So yeah, if there is anything, is there anything coming through, Karri?
Nothing
Yes.
more. Oh,
I'm
sorry, go ahead.
holding a sleeping baby, so it's hard for me to type, but I was wondering, like in looking at new, is there a tool that you have for looking for new products to add to your mix? Like which one, when you're guesstimating what will, well, should I do X or Y as my next product?
Okay, so
Right.
yeah, I guess to answer that question, then the first thing I would make sure of is that your financial model with your existing products and services is financially sound. Before we start adding any more, confusion to the mix, let's just make sure what we have now works really well. And then if we're looking at building another, or looking at introducing another product or service, I would definitely go through the weighted pricing model. We do the exact same exercise, but even before that, I would look at trying to figure out if we could launch a beta or get feedback from our existing customers as to whether or not there's an appetite for it. And if we could go as far as to get pre-orders for it, right? To just communicate, here's what we're looking at doing. This is hypothetically what it would look like, what it would do. Would you be interested? And most people, just so you know, are going to say, yes, please, yes, please. And then it's going to come time to buy and they're going to, oh, I don't have money, I don't have money. So if you can get the pre-orders in, now you're actually defending the value of that product or service, which is what is brilliant about crowdfunding, right? Because it actually says, yes, there's an appetite for what you do and people are willing to pay for that in that process. Great question.
And great answer.
I love, sorry, I see something coming up here. For a purpose-driven company, is it normal to undercompensate your, oh, don't do that, Jenna, don't. I work with so many nonprofits that it's the mentality that we have to get around, right? Just that word, I know purpose-driven business kind of falls into social entrepreneurship and not-for-profit. You have to come first, Jenna. This is so uncomfortable for so many women to put ourselves first. We're so used to coming last, and that's inherited. That's inherited, so so that 3 different types of programming. This martyrdom piece is inherited programming that comes from our generations that came before us. So for you to change it, you just have to see it, and we have to choose the uncomfortable stuff, which is putting us first. So with profit-driven or social enterprises, not only do you pay yourself a fair market salary, but you also make sure that if there are any social initiatives, like I'm going to plant a tree for every 10 pairs of shoes that I sell, that tree cost isn't coming out of your net profit, it's actually bundled into your cost of goods. right? We have to take it from the profit, put it in there, because even for socially driven businesses and nonprofits, you still have to profit. It's just what you do with the profit that is different. You're accountable for that profit being reinvested either back into your organization or for social impact. But you still have to profit. You still have to do that. Thank you, Jana. That was a really important question. Thank you for that. And, you know, if I can share, there's one question that always comes up. Well, how am I supposed to pay myself when there's no money? How am I supposed to do that? How am I supposed to show that? What I want you to do in these early days until you get your business to a profitable level is I want you to show the business actually paying you. So there's a cash withdrawal going to you. You take that money. And now if you need to put it back into the business, guess what? It's a shareholder loan. You're investing your money back into the business. It's actually on the books. It shows that you've put that money back in there. It shows that the business owes you that back, right? It's just a very different way of thinking that's going to be uncomfortable at the beginning, but it completely shifts your mindset. And it's doing those uncomfortable little things that shows you that you're changing the programming of your subconscious, which is what is going to continue to drive 95% of your decisions. We don't get around that part. That part doesn't change. It's always 95%. We have to change the programming, and that's how we do it, by doing the work that's uncomfortable, not the hard work, the uncomfortable work. All right, I've taken up a lot of your time. I apologize. I'm 7 minutes over, and you ladies deserve this time to finish your introduction. So I'm going to step away. I want to again just applaud all of you. Thank you so much. I so value you showing up here. There is so many resources in there, Brandy, and we just keep throwing them in there. And we're starting a really fun vlog at the end of the month called the Gab Lab, where we're going to have sessions just like this. So thank you for your time. Enjoy this process. Again, thank you for the courage to build your business. And I'm here for you at any step of the way. Please don't hesitate to send me a text or an email. You've got this. Thank you, Karri, for all your great work. And thank you, Lori, if you're there. And I'll catch you on the next round.
Thank you.
Bye,
Thank you
everybody.
so much, everyone. Thanks, Tanya. Appreciate it. Great. Well, this was fantastic. What a great start, huh? Let's take a